Hello, everyone, from Berlin. We have published the annual results 2017 this morning and the outlook for 2018. You know this. We will, as always, start with Matthias Döpfner's statement on the strategy, and this will be followed by Julian Deutz's statement on the financials, and then we will move on to your questions. And with that, I hand over to Matthias Döpfner.
Hello everyone and welcome to our conference. Today we are looking back to an excellent 2017, at the same time looking forward to a very good 2018, and we had a good start into the year. Let's turn to chart 3 for an overview of what we have achieved in 2017. As you have probably seen in our report this morning, we have fully achieved our earnings guidance for the year and even exceeded the revenue guidance. And you might remember that we had even increased our initial guidance in August last year for EBITDA and EPS. Our revenues increased by 8.3% and reached more than 3.5 billion euros. Our EBITDA stood at 646 million euros, corresponding to an increase of 8.5%. And of course, very importantly, our EPS reached 2.60 euro and was therefore up 8.1%. We, as much as our shareholders, have been pleased by the strong share price increase of 41% during the last year and also the further uplift since the start of this year. In order to further benefit our shareholders and on the back of the very good operative development, we are also proposing to increase our dividend from 1.90 euro to 2 euro. Chart 4 shows how dominant the digital part of our business has become. In 2017, 71% of our revenues and even 80% of our EBITDA has been generated by digital activities. And the organic growth in revenues of our digital activities was very strong too. They grew 12.5% year over year and even accelerated towards the end of the year with a further accelerating growth of 14.5% in Q4. The next chart, chart 5, shows the 4 important objectives that we have set for ourselves and that we have communicated in early 2017. The announcement, but obviously even more important, the clear execution has been taken positively by the market. We had promised 4 things. Firstly, we wanted to give you more disclosure on the classifieds business, our strongest and most valuable segment. Secondly, for the first time and in order to counter the exaggerated skepticism on our news media business, we gave a mid-term guidance for EBITDA stability in that segment. Concerning the range we gave for the EBITDA here, we have included changes from the new accounting standards IFRS 16 in this range now. Julian will talk you through these accounting changes later. Thirdly, we promised strict M&A discipline in digital content until we have proven profitability of the existing businesses. And finally, we communicated our clear focus on classifieds and content, which we underlined by active portfolio management. On the chart, you find some selected examples of clear proof points regarding each of the 4 topics. Again, we have received positive feedback on our execution, and we are committed to continue on this successful path. Chart 6 addresses another important aspect of 2017, as we have also been very successful in optimizing our capital structure through several real estate transactions. We have sold the office building called Axel Springer Passage that is situated next to our existing headquarter high-rise to Blackstone for a purchase price of 330 million euros and made a profit of 130 million euros. We also contributed to the high-rise to our contractual trust agreement in order to fund additional parts of our pension liabilities, thereby reducing them by around 140 million euros. And finally, we signed a forward sale and leaseback contract with Norges for the new additional headquarter building that we are currently building just opposite the street of our existing high-rise. The purchase price for this amounts to 425 million euros. Further details on the transactions are shown on the chart and will also be commented by Julian later. This shows you that we are not only pursuing an active portfolio management regarding our operative assets, but also with regards to our real estate. Finally, let me give you an outlook on 2018 on chart 7, more in a strategic sense, while Julian will comment on the financial outlook later. What can you expect from us in 2018? We will continue to deliver on our 4 important objectives. This clearly means that we will have a constant focus on further growth in the classifieds business. It also means that we are confirming our guidance for a stable EBITDA in News Media. Within News Media and in line with the expectations that we have shared with the market for some time now, Business Insider should reach the break-even in the second half of 2018. And finally, we want to intensify the exploration of further potential from technology and data for Axel Springer. We are convinced that by making even better use of already existing technology and data, but also of trends and capabilities that are just emerging, we can both support the sustainability of the growth we are experiencing and also further accelerate the growth trajectory. You may have seen that the Supervisory Board has appointed Stefanie Kasper as our new colleague on the Executive Board, focusing on technology and data. We think that is a very clear message regarding priorities. With that, I would like to hand over to Julian for a closer look at the financials and also the outlook.
Yes, good afternoon also from my side. Thank you, Matthias, and I'm happy to guide you through the financials. So chart 9 shows the development of group revenues and adjusted EBITDA. Revenues were up 8.3% in 2017. The organic increase, meaning adjusted for consolidation and FX effects, was 6.3%. Consolidation effects, as you know, came mostly from 3 sources. We had effects from Land & Leisure in the classified segment and eMarketer in the News Media segment. Both these 2 effects mainly impacted the first half of 2017. Then in the performance marketing business, after buying back the stake from Swisscom, we had an effect from the merger of Awin with Affiliate in Q4. Adjusted EBITDA was up by 8.5% and 4.5% organically. Operationally, Q4 has been another strong quarter with revenues even growing double-digit, but mainly for 2 reasons. We are showing an EBITDA decline here. Firstly, as announced in the Q3 call in early November, we identified significant additional restructuring opportunities, in particular in the News Media segment in Germany, which led to corresponding expenses. Secondly, due to the very strong share price increase in Q4, stock-based incentivization programs led to significantly higher expenses. As in prior quarters, the classified segment continued to be the main driver of revenue and EBITDA development of Axel Springer. On chart 10, you find the segment overview. Revenues were up 14.6% on a reported basis and 12.7% organically. This is the 3rd year in a row where the segment is posting organic revenue growth of almost 13%, thereby significantly outperforming the guidance of roughly 10% organic growth we've given in the past. Adjusted EBITDA grew by 16.5% and was up 14.7% organically. The margin saw a slight improvement and reached 41% in 2017. With these numbers, the classified segment accounts for 56.8% of adjusted group EBITDA. Looking at the different subsegments in classifieds, let's start on slide 11 with jobs. The jobs vertical, so the Stepstone Group, grew its revenues by 15% on a reported basis in 2017. There have been only minor consolidation effects, but some negative FX effects from UK. Adjusted for those, the job classifieds revenues were up organically even by 17.0%. As you know, the continental European operations are the main growth driver and had overall a really good year with organic growth of 23.8%. But also important, the UK operations, where, as you know, in 2016 we had some operational issues, are showing further signs of an improvement with higher growth rates again. Organic growth was 6.6 for the full year, but comparing H1 to H2, the second half was clearly stronger with an organic growth of 8.6%, and Q4 even stronger than Q3. Adjusted EBITDA of job classifieds was up 12.2% year-on-year on a reported basis and 12.4% excluding consolidation and FX effects. Margin was still strong at 41.7%. The slight decline was due, amongst other things, to higher marketing spendings to secure future growth. Turning to the real estate vertical on slide 12. Revenues in the segment on a reported basis grew by 7.2%. Organic growth was double-digit with an increase of 10.8%, and the reason for the difference between the two numbers is a deconsolidation effect of the small software business that was run by SeLoger until last year. All assets showed either high single-digit or low double-digit organic revenue growth for the full year 2017. You'll find the detailed figures in the appendix of the presentation, and the strongest growth again came from Immowelt in Germany, which grew 13.2%. Adjusted EBITDA increased strongly by more than 20% on a reported basis and by more than 21% on an organic basis. As in revenues, by far the strongest increase came from Immowelt with a really phenomenal performance. But also SeLoger in France and Immoweb in Belgium added to the increase in EBITDA. Finally, slide 13 gives more details on the general other subsegment. Revenues grew strongly by 23%. Consolidation effects due to the acquisitions last year of Land & Leisure as well as Traumferienwohnungen played a significant role. The organic growth stood at 6.3%, partly due to higher comps in H1. Organic growth was stronger in the second half of last year. Adjusted EBITDA was up 20% to 78.1 million euros. On an organic basis, the increase was 8.5%, and margin was only slightly down, so pretty much on the level of the prior year with 32%. On chart 14, you find the figures for the News Media segment. Revenues in this segment were up 1.9%. In terms of consolidation effects, we had the strongest impact from eMarketer that was consolidated since July 16. Organically, revenues were on prior year level. Looking at the share of digital in this segment, this number is basically climbing up step by step, and it now stands at 33.9%, up from 29% last year. The increase was supported obviously by the acquisition of eMarketer, but also by the strong growth of Business Insider. In the international business, the digital share has already increased to 61%. As a reminder for the German news media business, we had a very strong Q3 with advertising revenues actually even slightly up in the print part of the business. Adjusted EBITDA in news media was up by 2% on a reported basis and with 218.8 million euros, well within the range for a stable EBITDA that we gave you exactly a year ago. As announced in November and following the decision to restructure the publishing units in the German business, we saw a significant increase of restructuring expenses in the final quarter of the year, which led to the expected decline in EBITDA in Q4. Let's look at the marketing media segment on chart 15. Reported revenues were up 15%. Especially the fourth quarter benefited from consolidation effects, and here mostly from the merger between Avon and Affiliate, which closed in October. Adjusted for consolidation as well as FX effects, revenue increase in the full year reached 12.4%. Adjusted EBITDA went up by 16.3% in 2017 year-on-year and by 8.4% organically. Thereby we've reached the guidance, which clearly was the most ambitious, and I think we talked about that during the quarterly calls in 17. So the most ambitious one among the different segments, and the strong increase in Q4 by more than 60% was helped to some extent by consolidation effects, mostly from the merger in the performance marketing, but still EBITDA adjusted for consolidation and FX effects was up almost 50%, due to, amongst other things, a very strong performance at Finanzen.net. They had a quite unusual finish of the year thanks to the hype around Bitcoins, which enabled them to generate additional revenues from selling leads for Bitcoin account openings. So a very nice effect there. Let's turn to the bottom line for the group on chart 16. So the fact that all three operational segments increased in both revenues and in EBITDA lead us also on to a very positive picture on the bottom line. Looking at depreciation and amortization, this number increased from 124 million euros in 16 to 142 in 17, and this increase was partly driven by higher investment for technology in prior years. Adjusted EBIT therefore increased from 471 to 504 million euros. The financial result was slightly better than last year and in line with what we have expected for the full year. Similarly, the tax rate on adjusted result improved slightly to 32.6% from the 33.3% in the prior year. Looking at the minorities, the number went up from 40 million euros in 2016 to 47 million euros in 2017. This was driven by a good performance, especially for those assets which still have a minority position, such as, for example, Immowelt. Overall, this leads to an increase of 8.1% for adjusted EPS to 2.60 euro, which is in line with our guidance and also in line with the adjusted EBITDA increase. On chart 17, you find an update on our net financial debt and free cash flow. Our net debt at the end of December 2017 stood at 1 billion euros, which corresponded to a net debt to EBITDA ratio of 1.6. This includes the positive net cash inflow resulting from the closing of the sale of the Axel Springer Passage in Q4. It does not yet include any effects from the disposal of Aufeminin. With the publication of our 2016 full year figures, we started to give you free cash flow numbers with and without the effects from our headquarter real estate transactions. This year, both numbers are significantly up. The free cash flow without the effects from real estate is up significantly by more than 110 million euros year-on-year. The reason for this development are the strong EBITDA increase, especially considering that this increase is negatively impacted by non-cash effective higher allocations to reserves for the restructuring programs and for long-term incentives. So both the effects I touched on for Q4 17. Obviously, these higher reserve allocations will reverse in higher cash payments in 2018, thereby limiting the free cash flow increase. It will therefore be more or less, we believe, on the prior year level, potentially even slightly up year-on-year. Furthermore, the cash flow increase in 2017 results from tax refunds received for prior years and lower payouts for long-term incentive programs and restructuring measures compared to 2016. So basically, as you remember, we had a couple of negative one-off effects in 2016. Apart from the development of the operative business, there will be some bigger effects on the net debt development on the back of the transactions we've already announced. We are expecting a net cash inflow of around 130 million euros from the disposal of Aufeminin and partly offsetting this from the acquisition of Logic Immo, so that's the net figure, and this will take place within the first half of 2018. Over the time frame 18 to 20, we expect another positive cash inflow of around 165 million euros from the sale of the new building here in Berlin. And partly in 2020 and then in 2022, we are looking at another 170 million euros from the envisaged sale of our stake in Doan. And as you know, we have a put option with a bank guarantee for that. In total, between 18 and 20, we expect a positive cash inflow from these already signed transactions of more than 420 million euros. So financial headroom, we believe, really looks good. Coming to the outlook of 2018. As you know, and as we've already announced in November 17, together with our 9-month results, we are going to adopt 2 accounting changes that will have significant effects on our numbers. Slide 19 gives an overview of the changes relating to IFRS 15 and the recognition of revenues. This change is mandatory as of January 18, and it's basically a complete overhaul of the principles of revenue recognition. For us, this mostly concerns performance marketing with the Aving Group. Here we are now switching from a gross to a net revenue reporting, which we actually also think is the economically better way to look at the business. And you know from many conversations we have discussing about that for a long time. So now we are basically able to report the business in a way what we believe is the right way to look at it from a business side. So in the past we had to show all the revenues that the advertiser paid to the Aving Group, which included those parts of the advertiser's commissions that were ultimately paid to the publisher. In the future, we will only report those revenues that are not passed directly on to the publisher, and that means that the reported revenues in performance marketing segment decreases by approximately 75%, as announced in November. EBITDA obviously is not impacted. Correspondingly, the margin will increase sharply from around 5% to around 20%. And starting with Q1 18, we will report the lower revenues, but also give you restated numbers for the prior year 2017. Please turn to the next slide 20, for an overview of the second accounting change that we will implement. This change comes through IFRS 16, which deals with the accounting of leases. This change is only mandatory as of 19, but we have just decided to adopt it as early as possible. So as of 18, because we simply wanted to avoid 2 consecutive years with changes in the reporting, and we believe it's easier to go once through that. The new standard states that operating leases longer than 12 months have to be recognized as assets and liabilities. So far, obviously, the leases from real estate, IT hardware, or cars, for example, have simply been shown as other operating expenses and were part of EBITDA. Going forward, they will be shown as depreciation and interest expenses. Consequently, this change in reporting will lead to a corresponding uplift of EBITDA. The impact of our numbers is shown on the right-hand side of the chart, so we expect 45 to 50 million impact when comparing 18 to 17. One important remark here. Some of you will remember that we estimated a range of 60 to 65 million euros for the effect of IFRS 16 on our 18 numbers in November last year to illustrate the accounting change effect on a single year alone. This number basically shows the increasing effect of the new accounting standards on all of the lease contracts that are in existence in 2018. In order to provide you with an additional view, we have now also looked at what impact the accounting change has when comparing 17 with 18. We believe that is, from your perspective, the better view. Here, some leases that due to IFRS 16 don't have an effect on the 2018 EBITDA and are therefore included in the 60 to 65 million range, simply did not exist in 2017. And the 2 main reasons here are the rental payments for the Axel Springer Passage that we sold as of December 31st, 2017, and the Berlin high-rise building that we are leasing back since January 2018. In that sense, when comparing apples to apples, the effect on the 2018 EBITDA from lease contracts that existed prior to 18 should be in a range of 45 to 50 million euros. And please contact us or Claudia and Daniel if you want to discuss further details here. We admit that this is going to be a bit detaily and technical, but I think it's important we try to give you as much transparency as possible there. All in all, looking at this year's outlook, there are some important moving parts to consider when giving the guidance for 2018, and on chart 21, we are summarizing all of that. In addition to the accounting changes, our outlook also accounts for consolidation effects, especially the acquisition of Logic Immo in France that closed in February. It also assumes closing of the Aufeminin transaction by the end of April 2018. Furthermore, and relevant for the sub-segments within classifieds, we are handing the management of our German regional portal meinestadt.de over to Stepstone. Given that 60% of Meinestadt revenues comes from job classifieds, we are confident that this will simply unlock operational synergies for this asset, and as a consequence, we will be reporting Meinestadt going forward in the job classified sub-segment and not in general other anymore. On chart 22, you find our outlook for 2018 for the group, encompassing all of these changes. According to the new accounting standards we've just mentioned, we have decided to give you a more detailed outlook this year. Therefore, we provide an outlook for our reported as well as for our organic figures. Organic in this case includes not only the adjustment of consolidation and FX effects, as in our usual understanding, but also includes adjustment for IFRS effects, and this should really enable you to compare apples to apples and have, in a slightly complicated phase of the IFRS regulations changing, a view as clear as possible. As mentioned before, IFRS 15 changes will be reflected in the restatement of the prior year numbers as of Q1. Therefore, no adjustment between reported and organic is necessary. For the group, we expect a low to mid-single digit increase in revenues on a reported basis. Adjusted for consolidation, FX and IFRS 16 effects, we also expect an increase in the low to mid-single digit percentage growth area. For the adjusted EBITDA, we expect low double-digit percentage growth on a reported basis. For the organic development, our expectations for the adjusted EBITDA mirror the guidance that we gave last year in March. We expect an increase in the mid to high single-digit percentage area. Regarding adjusted EPS, we expect a low to mid-single digit percentage growth on a reported basis, adjusted for the effects from the change in IFRS 16, as well as consolidation and FX effects. We expect a mid to high single-digit percentage increase. On chart 23, you find the detailed outlook for the segments for revenues and adjusted EBITDA, again, both reported and organic. I'm not going to talk you through all the details, but just want to mention two important aspects. As you see, we are continuing to see high single-digit to low double-digit organic percentage growth in the classified segment for both revenues and EBITDA. News Media segment will see a slight organic decline in revenues following excellent 2017 in the German advertising market. We therefore expect a low to mid-single digit percentage decline for organic EBITDA in the segment. This is mostly a function of the revenue decline. Also, we will work hard on the cost saving side, as you know from prior years. Matthias has already mentioned that we are adjusting the EBITDA range we have given in connection with the midterm EBITDA stability guidance for the effects from IFRS 16 change. So we really want to be, again, make sure that we don't have any, you could call that, advantages through that. This lifts the range by 20 million euros to 225 to 245 million euros. And obviously we expect EBITDA to be within this range also in 2018. So this was a lot of additional information, so more than normally in March, and we are now looking forward to your questions.
Ladies and gentlemen, at this time we will begin the question and answer session. Anyone who wishes to ask a question may press star followed by 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star followed by 2. If you are using speaker equipment today, please lift the handset before making your selections. Anyone who has a question may press star followed by 1 at this time. And the first question is from the line of Christopher Johnen with HSBC. Please go ahead.
Yes, thanks for taking my questions. First, on your guidance in classifieds, could you maybe give us a couple of comments both on revenue and EBITDA for each of the different classifieds verticals where you see dynamics, things that you want to flag that we should remember? And should we see the guidance as sort of a deviation from your previous comments that you saw 10% or more organic classified growth and EBITDA growth? I think there are a couple questions on why, compared to the previous years, you include the possibility of high single-digit growth in the guidance. Second question on marketing models, maybe a bit of an update on the portfolio reshuffling. Aufeminin is done. Is there maybe an update on Idealo? Anything that we need to know in terms of whether or not the sales process is ongoing? Anything on that would be interesting. And then I may have a follow-up. Thanks.
Sorry, there was a problem here with the headset. Can you hear me now? Okay. So Chris, thank you for your questions. Let's start with classifieds guidance. First of all, I think that the most important message is no deviation from our midterm view on classifieds and from our midterm around 10% guidance for increase in revenue and EBITDA. And as you know, we have outperformed that over the last couple of years. Maybe to add to that, looking at the February numbers, where we had, especially in the first 2 months, a great performance again at Stepstone Continental. So mainly, as you know, Germany growing with around 30%. Revenue guidance, I admit, looks for classifieds, looks from today's perspective somewhat conservative. Going through the segments, I already started with obviously StepStone, Continental Europe. I start with revenues here and come to EBITDA in a second. Revenues or top line looks very good in the first 2 months. In UK, we've seen in 2017, basically quarter by quarter, almost an increase. We said, okay, we want to get back with organic revenue growth at around 10%. We were almost there already in Q4 and had also a good start into the year here. We believe this around 10% is not unrealistic. Looking at real estate, you know that much of the growth was driven, or the strongest growth came from Immowelt, and we continue to be optimistic here because we simply see that we continue quarter by quarter to take slight market share from ImmoScout, and are absolutely confident also to reach the margin target of 40% in 2019. Things look good here. SeLoger, which was for a long time, as you know, more a mid to high single-digit growth asset, and then for a phase of really great market conditions in France was slightly or low double-digit, is probably, again, if we look on a horizon of 1 or 2 years, more again mid to high single-digit, I would expect. These are the two obviously most important sub-segments. On the EBITDA, so on the bottom line, we continue to believe that for us as long-term holders and really long-term players in this market, as long as StepStone is able to deliver this great top-line performance, that it's the right thing to do is to not look too much on EBITDA margin. And you know this is, even if it's slightly declined, it is with around roughly 40%, we believe still a very strong margin. But to really look that we make sure that we invest enough into the business, and that means marketing, so brand marketing. That also means traffic acquisition costs, which slightly increased compared to revenues, and which also means that we would like to enter or invest, let's say, a couple of million euros in some of the smaller markets where we are already active, but where we don't have this strong position, as for example in Germany or in UK. And just to give you an example, we did that and didn't even talk, I think, a lot about that. We did that in Austria, where we were number 3 or number 4 player, invested a couple of million over the last 2 years. Austria was a market where we grew with more than 35% in 2017. And even if this, obviously, you could argue on the whole level of Axel Springer doesn't move directly the needle, it is, we believe, something that we should definitely do, and we want to do that. I would like to continue to do that. And then, in addition, obviously, the change of Meinestadt, which is a lower margin asset than StepStone, will have a certain, not great, but a certain decreasing impact on margins there. So overall, we continue to be very optimistic in classifieds, and there's no deviation to our midterm guidance. Your second question, marketing models, where do we stand there? We said, and this has not changed, that the priority going forward is on classifieds and news media. We have 3 big assets in marketing, or Femina, as you say, it's done. Closing should happen in April, hopefully, or in Q2. Awin, so former Zanox Group, we have prepared that, bought back the stake of Swisscom. As you all know, now it's a merger. Now it's really into integration, which will take probably at least for the full year of 2018. At Idealo, we see 2 aspects currently. On the one hand side, a really good operational performance in 2017, and really additional upside from cooperation between news media and Idealo. And while you could argue, well, you have these assets already for 10 years, we've really focused more on a standalone case with Idealo. And as you know, this was for many, many years very successful. So this will also mean that you won't see any, say, M&A activity for Idealo for 2018, because we believe we can further increase the value of this asset.
Okay, that's very clear. Thanks. Maybe one follow-up on, well, not really follow-up, but on Business Insider after the performance of 2017. Could you maybe give us an idea of whether or not you've seen any significant impact from the newsfeed changes at Facebook, and what sort of target revenue growth range you think is realistic for 2018? Thanks.
So as you know, Chris, with Business Insider, we had a phenomenal performance in 2017, and we told you quarter by quarter that we have this great performance, but that we can't guarantee that, obviously for the full year, and then basically we had it for the full year, and had then an organic revenue increase of more than 45%. We were, as you always know it, a bit, don't want to call it cautious or conservative with the revenue impressions for 2018. The first 2 months have again been very, very strong, and Business Insider in the first 2 months grew by around 40% again in local currency, obviously a little bit less due to the dollar devaluation, but obviously looking at it in dollars is the right thing to do. So again, very positive. Facebook, was Facebook basically changed, will probably have some traffic impacts on Business Insider. So as you might know, Facebook started with this new algorithm even much before they talked about it. So we basically know this already since mid-2017, both for the German assets and for the US assets. We believe we don't have a big impact on monetization here, but we obviously follow that closely, and are happy to talk about that quarter by quarter and give you an update there.
Okay, very clear. Thanks a lot, guys.
And the next question is from the line of Nick Dempsey with Barclays. Please go ahead.
Yeah, I've got 2 questions left. So first one, I believe you had 2 schemes from 2014 in relation to management stock options. Can you remind us broadly what the criteria of those were, how you're now doing in relation to those criteria, and when those schemes kind of come to an end? Second question, I guess it's follow on really from what Chris asked about classifieds, but for the group, sort of low single digit to mid single digit organic revenue growth guidance, kind of what would have to happen across the group for you to deliver low single digit organic, and or have you really thrown that in as a bottom end for really exceptional circumstances?
Nick, thank you. So the stock appreciation rights programs were something I think we started in 2008 or 2009. And we have basically 2 programs that are still in place. The criteria is that they run for 4 years, and if there's an increase, so there are basically two criteria that both have to be fulfilled. One is that without dividend payments, the share price increases by more than 30%, and that's always taken a 30 or 93 months or 3 months volume-weighted average price, obviously. And then we have to outperform the DAX. So basically 30% without dividends, absolute performance, and then better performance than DAX. Given the current share price, even after this day, both programs are in the money. Obviously, that might change. You'll see all the details in the annual report, by the way, and the basis is around 44, 45 euros per share. So unless we are basically, to make it a simple example, unless anything happens with the DAX or DAX performance relative to Axel Springer performance, or unless the share price goes for a certain time below 60, these programs are in the money and could all be exercised before the end of the year. One program as of April and the other program as of December. So was that helpful, Nick?
Yeah, that's clear.
Okay. You basically ask again, or whether our revenue growth guidance with low to mid single-digit increase is a little conservative. I think that's what's behind your question. I mean, as you know, we have a history here of, I don't know, over the last probably 10 years, really delivering on our guidance. And you could argue to achieve that 10 years in a row, maybe it always has to be a little conservative. We are, let's put it that way, from all we can say today, if the economic climate stays as it is, we are confident to be more in the mid single-digit organic growth range than in the low single-digit organic growth rates. And when Chris asked this question, I just said that for classifieds with now more than 1 billion revenues is obviously an important factor. I already said, looking at February, especially at this great performance top line of StepStone Germany or StepStone Continental, classifieds revenue guidance looks somewhat conservative, and this also obviously plays in the whole revenue guidance here.
Okay, that's clear. Thank you.
Next question is from the line of Craig Abbott with Kepler Cheuvreux. Please go ahead.
Yeah, good afternoon, everyone. I have a couple of specific questions on Immowelt and the KPIs there. I'm trying to reconcile a little bit your statement that you continue to gain market share, and yet, according to your charts, it looks like some of the key KPIs, in particular listings and traffic, have slipped a bit. I think even the listings were down 5%. Is this primarily due to the elimination of double listings on both websites, the Immowelt and Immonet? If so, could you maybe also give us an update on what the share, roughly, of the double listings is? And also sticking with Immowelt, could you just confirm you're targeting further double-digit ARPU growth again in 2018? And if so, is that likely to be primarily price-driven again, or are there also maybe mixed effects here? Thank you.
Hi, Craig. Thanks for your questions. So first of all, this duo initiative, meaning bringing listings from Immonet, or bringing basically people who were only on one of the two platforms, either Immonet or Immowelt, to the combined platform. This rollout is now complete, so there are no longer double listings. And when we talked about gaining market share, we compare on a quarterly basis the revenue, the operational or the organic revenue development between our Immowelt and then the real estate activities of the Scout Group in Germany. And there we can see quarter by quarter, I think now for 6 or 7 quarters in a row, that we've been able to slightly or step by step outgrow their pace of development, which we believe for number 2 is really good. ARPA growth should be low double digit in 2018, and this will be the main driver, as we know from other real estate activities also within the group, will be the main driver of revenue growth.
Okay, thank you. That's very helpful. Maybe I can just follow up again, though. Can I just confirm that the 5% listing decline that you show us, was that due to the transitioning of the customers onto the dual platform? Was that the reason? Or there's real, is that a real?
No, I think it's more a market. It's more a market effect. We saw, it's right. We saw a slight decrease there in listings, so mid-single-digit % range. And overall in the market, what we see and what we hear from competitors, I mean, it's a tight German real estate market. It is basically, as we know from the price development, kind of overheated. If you talk to agents, they all tell you it's super easy to find buyers now. So you could argue it's not even the best time for us with the portals there, but it's super difficult to find property. And this is why overall listings in the market went down.
Okay. Okay. Thank you, John. It's very helpful.
Yep. Yeah. Thanks, Craig.
Next question is from the line of Marcus Diebel with JP Morgan. Please go ahead.
Hi. Two questions left from my side. First is again on classifieds and the operational gearing, in particular in jobs. At the Capital Markets Day, you answered the question that there shouldn't be a reason why jobs is a structurally lower margin vertical than the others. Now we've got a 17% organic revenue growth with flat margins. Clearly, I understand the need for investments, but why shouldn't we think that we just need to pay a bit more for the same kind of revenues, so that this is more longer-term theme that we probably see structurally lower margins in jobs? So if you could maybe elaborate on this a bit more. And then secondly is on the financial leverage. We are now at 1.6 times EBITDA, net debt to EBITDA. I've got you on my numbers at about 1 times this year. So what is, in your view, a comfortable level of leverage? And given the absence of sizable M&A, how shall we think about cash returns? And at what level is that more subject than today? Thank you.
Yeah, let me take the question on Stepstone. I mean, I think we have proven our theory about the structural robustness and the growth potential of Stepstone and the whole job segment pretty impressively over the years, since we have accelerated the growth rate over the last years. And the question is, of course, to which degree do you balance growth and margins? Of course, if we would be happy with a 10% growth, we of course would have even higher margins. We think that this business has so much midterm and long-term potential that it would be the wrong priority to maximize margins in the short term. The structural healthiness of the margins are reflected in the German business, where we reach margins north of 50%, up to 60%, where the margins are already higher than in some of the real estate markets and assets. So that shows that the business can be structurally that profitable, but it is still a mix of more mature markets, of some markets like England with very concrete issues that we have fortunately solved, and that's why we are back into the growth mode, and that's why we are accelerating here the growth rates again. But you know that we had problems here, problems in the sales team, management problems, market issues. That is now going to the right direction, but that of course dilutes the average margin. But in general, we think that with this 40 plus average margin, we have a good balance, and we are still able to reach these high growth figures. And also here, the growth rates are different in the German core market. They are higher in other markets. They are lower in very undeveloped markets. They are extremely high. So that is really a mixed picture. But I think overall, the message that structurally the job segment is as profitable, can be as profitable as the real estate business remains intact. The other question on M&A and debt leverage, Julian, would you like to answer that?
Yes, I can do that. So Markus, I mean, we are now at 1.6, obviously, and we expect the inflow from Ofemina, which will obviously bring leverage further down. We are comfortable with the leverage. We always say 2 to 2.5, and given the continuing favorable interest rate environment, we would absolutely be fine also with a leverage of 2.5. I think we stick to the policy that we say if we really for 12 to 18 months don't find the right targets, then we would think about additional shareholder returns, and we try to have obviously regular cash returns now with increasing dividends. But we believe today we are not in a situation where we would say for the next 12 months there is nothing on the M&A horizon. So, and only if this would be the case, I think then we would really think about significant cash returns to shareholders. And I think that's a policy that, from our understanding, has always been appreciated by shareholders. And as you know from the history, I think we always found the right target. It's probably somewhat more difficult in classifieds now for the last 2 years than it was, say, in 2012 or 2013 when we have been building our strong position here. But there's still interesting opportunities on the market.
If I may add here, in general, we have said over the last 1.5, 2 years that we want to be reluctant with further M&A activities and focus entirely on operational excellence and deliver what we have promised. And I think so far we did very well. You should not expect a very spectacular 2018 with regard to acquisitions, most likely. There may always be once-in-a-lifetime opportunities, and then we should, of course, look at it and be flexible and take advantage of those opportunities. But in general, we see still a kind of focus on proof of concept on digital content. It looks very good that we are delivering that. We are very confident that we are going to deliver that, and then we will look for further investments in the B2C digital content area. We have already done 2 very successful steps in the B2B content segment with Politico and eMarketer, and we see a lot of interesting opportunities in that segment. And thirdly, of course, as Julian has already mentioned, classifieds. Here we also have opportunities in new markets maybe, but perhaps also opportunities with new innovative business models that are in a way adding new elements to the existing legacy classified models. And we are very intensively looking into these assets and opportunities. That's one of the reasons why we have intense traveling to the United States and in other markets. And if there are interesting opportunities, we are ready to take advantage of them. And you know that also with regards to the regional priorities, Europe remains a top priority. US is now a new second top priority with a lot of potential. And apart from that, other growing markets in democratic systems, we exclude non-democratic markets. And in a way that shows you that from India to Latin America to democratic Asian countries, there's room for further internationalization.
Perfect. Yeah, very clear. Just in terms of the M&A, you said before you wouldn't invest into loss-making businesses. Do I get that correctly? Is that still the case?
Yes, that is still the case. Yeah, that is still the case until we have, in an undebatable way, proven the structural profitability of digital content assets. Of course, Business Insider is here a kind of lighthouse asset, and that message remains absolutely intact. And until then, we would not do that. Of course, in the mid and long term, there may be opportunities also since valuations of some of the assets went down a little bit. So we think, as we said several times, this segment is going to be the next growth and value driver of the company.
Okay, perfect. Thank you.
All right. And since there are no further questions, we thank you all for your dial-in today. And if there are any more questions on the pretty complex package we have delivered to your doorstep today, Daniel and I will be back at our desks and on the phone in a little while. So please do give us a call or send us an email, and have all a great day.